From the straightforward one fund approach to the more intricate Ivy League endowment strategy. Ever wondered which investment strategy could best grow your wealth? Well, each strategy has its unique benefits and risks, but how do you decide which is right for you? Could these streamlined approaches to investing be the key to financial peace of mind? Well, let's unravel this together. 1. The one fund strategy. The one fund strategy is a simple yet powerful investment method that keeps things straightforward while gaining broad market exposure. This approach involves putting all one's investments into an S&P 500 index fund or a total stock market index fund. It's perfect for those who like to keep things uncomplicated. By focusing on a single fund, investors can steer clear of the complexities that come with managing a diverse portfolio. The S&P 500 Index Fund tracks 500 of the largest publicly traded companies in the US, while the Total Stock Market Index Fund includes a broader range of stocks, covering small and mid-cap companies too. The S&P 500 represents about 80% of the US equity market capitalization, making it a solid choice for those wanting market exposure without detailed stock analysis. And well, one of the most significant advantages of the one fund strategy is its simplicity. Investors can easily understand their investment's performance without juggling multiple assets. These index funds usually have low expense ratios, meaning more of the investor's money goes towards growth rather than fees. For example, funds like Vanguard S&P 500 ETF have expense ratios as low as 0.03%, making them a cost-effective choice for long-term investments. Moreover, both the S&P 500 and the Total Stock Market Index Fund offers broad market exposure, reducing the risks tied to individual stock investments. Historically, these funds have shown consistent long-term returns, making them attractive for those looking to build wealth. 2. The two-fund strategy. This well-loved approach blends a stock index fund with a bond index fund, striking a balance between risk and reward. The method aims to use the growth potential of the stock market while reducing volatility through the inclusion of bonds. A typical example involves investing in the Vanguard Total Stock Market Index Fund and the Vanguard Total Bond Market Index Fund. The former tracks the entire US stock market, offering broad exposures to large, mid, and small cap companies. Meanwhile, the latter invests in various US investment-grade bonds, including government, corporate, and mortgage-backed securities. Combining these two funds, investors can enjoy the stock market's potential for long-term growth, while using bonds to set the portfolio's risk off. Bonds usually have lower volatility than stocks, helping cushion the impact of market downturns. This balance becomes even more critical as investors near retirement, a time when managing risk and protecting capital is crucial. Increasing the bond allocation can help reduce overall risk exposure, providing a steady income stream, and preserve capital during market dips. For retirees, having bonds in the portfolio is incredibly beneficial. Bonds offer liquidity, allowing retirees to access funds without selling stocks during market lows, thus avoiding locking in losses. This strategy ensures that their retirement savings remain intact and can support them through their golden years. 3. The three-fund strategy. This one builds on the two-fund strategy by incorporating an international stock index fund aimed for broader diversification through global market exposure. A typical setup involves investing in the Vanguard Total Stock Market Index Fund, Vanguard Total Bond Market Index Fund, and Vanguard Total International Stock Market Index Fund. The first fund covers the entire US stock market. The second includes a range of US investment-grade bonds, and the third offers exposure to international stocks from both developed and emerging markets. By adding international stocks, investors can tap into growth opportunities worldwide, reducing dependency on the US economy. Historically, global stocks have shown lower correlation with US stocks, which helps manage overall portfolio risks during volatile periods. However, there's an ongoing debate about how much international exposure is necessary. Some investors argue that US stocks have generally outperformed international ones over the long term, favoring a more domestic-focused approach. Supporters of the three-fund strategy believe international diversification is critical to managing risks and capturing global market growth. They emphasize that the US market is only a part of the world's investment asset, and excluding international stocks can lead to an under-diversified portfolio. The performance of US and international stocks can fluctuate over shorter periods, making it challenging to predict which will outperform. 4. The 3-Fund plus 1 strategy. The 3-Fund plus 1 strategy further takes the classic 3-Fund strategy by adding a real estate investment trust fund. This inclusion aims to diversify the portfolio and benefit from real estate without the hassle of direct property management. Typically, investors allocate portfolios among 4 funds: the Vanguard Total Stock Market Investment Fund, Vanguard Total Bond Market Index Fund, Vanguard Total International Stock Market Index Fund, and Vanguard Real Estate Index Fund. The Real Estate Index Fund invests in REITs, companies that own or finance income-generating real estate. Adding a REIT fund brings several benefits. Real estate has historically shown a low correlation with stocks and bonds, which can act as a buffer during stock market volatility. REITs also generate income through dividends, often higher than those from traditional stocks and bonds, making them appeal to retirees or those needing regular cash flow. Moreover, investing in a REIT fund provides exposure to real estate markets without dealing with the complexities of property management, such as upkeep, tenant issues, or market fluctuations tied to individual properties. However, while this strategy offers enhanced diversification, knowing the potential risk is essential. REITs can be sensitive to interest rate changes when rates rise. Borrowing costs for real estate companies can increase, potentially impacting their profitability and stock prices. Despite this, the 3-Fund plus 1 strategy provides a balanced approach to investing. 5. Dave Ramsey's 4-Fund strategy. This well-rounded approach to investing emphasizes diversification by spreading investments across 4 types of mutual funds: growth and income, growth, aggressive growth, and international funds. In Ramsey's model, each fund category has a specific role. Growth and Income Fund focuses on capital growth and generating income, which is ideal for conservative investors looking for stability. An example is the Vanguard Dividend Appreciation ETF, which invests in companies with a record of increasing dividends. Growth funds target capital appreciation by investing in companies expected to grow faster than their peers, like the Vanguard 500 Index Fund, which tracks the largest companies in the S&P 500. Aggressive growth funds seek maximum capital appreciation, often investing in smaller, high-growth companies, such as the Vanguard Russell 2000 ETF, which focuses on small-cap stocks. International funds offer exposure to global markets, allowing investors to tap into growth outside the US, with the Vanguard Total International Stock Index Fund providing broad exposure to non-US equities. While Ramsey's strategy champions diversification, it leans heavily on actively managed mutual funds, which tend to have higher fees than index funds. Critics point out that these higher fees can eat into returns, and many actively managed funds underperform their benchmarks after accounting for costs. Studies show that nearly 80% of actively managed funds failed to beat the S&P 500 index over a decade. This raises questions about the necessity of actively managed funds in Ramsey's approach, especially when low-cost index funds, such as those from Vanguard, can offer comparable or returns with significantly lower expenses. 6. Bill Bernstein's no-brainer portfolio. This portfolio divides investments into 4 equal parts: U.S. large-cap stocks, represented by the Vanguard S&P 500 Index Fund, including the biggest and most established U.S. companies known for their steady growth and resilience. U.S. small-cap stocks, captured by the Vanguard Small Cap Index Fund, consist of smaller companies with higher growth potential, though they can be more volatile. On the other hand, international stocks accessed through the Vanguard FTSE Developed Markets Index Fund offer exposure to developed markets in Europe and Asia, helping to spread risk and benefit from global economic growth. And let's not forget bonds, including through the Vanguard Total Bond Market Index Fund. They provide stability and income, balancing the portfolio with lower volatility than stocks. The no-brainer portfolio simplicity is a significant appeal, making it ideal for investors preferring a low-maintenance approach. Bernstein's method is based on research emphasizing diversification across different asset classes to minimize risk. By allocating equally to each category, the portfolio aims to benefit from various market segments while reducing the impact of any asset's poor performance. Historical data supports this balanced approach, showing that diversified portfolios outperform those focused on a single asset class over time. Bernstein recommends low-cost index funds for their broad market exposure and low expenses, which can enhance returns. 7. The Ivy League Endowment Strategy. In this strategy, U.S. stocks represented by the Vanguard Total Stock Market Index Fund form a core part of the portfolio, offering broad exposure to large, mid, and small-cap markets. This reflects the historically strong performance of U.S. equities through the Vanguard Total International Stock Index Fund. International stocks provide access to developed and emerging markets outside the U.S., essential for global growth opportunities and reducing domestic market reliance. Through the Vanguard Total Bond Market Index Fund, bonds offer stability and income, acting as a risk management tool during market downturns due to the lower volatility compared to stocks. Real estate exposure comes from the Vanguard Real Estate Index Fund, which invests in REITs to provide income and potential appreciation, adding another diversification layer. And through the Vanguard Commodities Strategy Fund, commodities hedge against inflation and further diversify the portfolio with their low correlation to traditional asset classes. However, a key component of Ivy League endowments, private equity and venture capital, is typically out of reach for individual investors. These high capital, illiquid investments require significant resources and expertise to manage, and often necessitate being an accredited investor. This raises questions about the possibility of further replicating the Ivy League strategy for the average investor. While individuals can adopt similar asset allocation using publicly available funds, the absence of private equity and venture capital can limit potential returns. 8. The Coffee House Portfolio. This portfolio typically follows a 60-40 split between equities and bonds. It spreads investments across various asset classes, using 6 equity funds and 1 bond fund to achieve a balanced strategy. The funds often recommended included the Vanguard S&P 500 Index Fund, which provides exposure to the 500 largest U.S. companies, forming the core of the U.S. stock market. The Vanguard Value Index Fund, focusing on large-cap valued stocks that are typically undervalued. The Vanguard Small Cap Index Fund, which captures the growth potential of smaller U.S. companies. The Vanguard Small Cap Value Index Fund, targeting undervalued small cap firms. The Vanguard Real Estate Index Fund, offering exposure to REITs for income and potential appreciation in real estate. The Vanguard Total International Stock Market Index Fund, allowing for global diversification, and the Vanguard Total Bond Market Index Fund, providing stability and income through a diversified bond portfolio. Despite its straightforward design, managing multiple funds can introduce complexities, especially when rebalancing is needed. Rebalancing involves adjusting the allocations to their target percentages, usually recommended annually. This can be cumbersome for investors not familiar with tracking multiple funds. By the way, the varying performance of asset classes can also lead to significant deviations from the intended allocation over time. 9. The Ultimate Buy and Hold Portfolio. This portfolio comprises 11 funds, each carefully chosen to capture growth from various sectors and regions. Typically, it includes large cap blend, 6%, large cap value, 6%, small cap blend, 6%, and small cap value, 6%. For international exposure, the portfolio includes international large cap blend, 6%, international small cap blend, 6%, and international small cap value, 6%. It also incorporates emerging markets, 6%, via the Vanguard FTSE Emerging Markets ETF. To add stability, the portfolio allocates 20% to intermediate bonds through the Vanguard Intermediate Term Bond Index Fund, and another 20% to short-term bonds through the Vanguard Short-Term Bond Index Fund. While this strategy offers extensive diversification, it can be complex to maintain and rebalance. With 11 funds, investors must regularly check and adjust their allocations to stay on track with the strategy. Over time, varying performance among asset classes can lead to diversification from the target allocation, requiring periodic rebalancing. This involves selling high-performing assets and buying underperforming ones to return the portfolio to its original balance, which can be time-consuming and challenging for those who prefer a passive investment approach. Moreover, managing multiple funds can result in higher transaction costs if not done carefully. And investors must keep an eye on expense ratio to ensure that costs stay on track with their returns. And that's it. So, which investment strategy do you think suits your financial goals the best, and why? Comment down below. Also, leave a like, subscribe, and don't forget to turn on the notification bell for more amazing videos.